Before she retires next month at age 52, Rowan in Georgia wants to maximize growth in her IRA, which will be funded with 72T early retirement withdrawals. What did Joe and Big Al think of her substantially equal periodic payment plan, and how should she allocate it? Michael in Virginia isn't interested in any international investments and is instead invested in stocks like Google, Amazon, Microsoft, Meta, and Berkshire. What adjustments would the fellows make to his portfolio for long-term growth? That's today on Your Money, Your Wealth podcast number 533. Plus, our friend Will, who is not a gas siphoner, wants Joe and Big Al's opinion on backdoor Rothing his solo 401k instead of having an emergency fund, and on what he should do with his annuity. Also, the fellows explain ESOP and NUA, that is, employee stock ownership plans and net unrealized income for Tess and Finn in Texas. I'm executive producer Andy Last with the hosts of Your Money, Your Wealth, Joe Anderson CFP and Big Al Clopine CPA. To get our retirement spitball analysis of your own, click or tap Ask Joe and Big Al in the episode description to send us an email or a voice message like this one.
Hi Joe, Big Al, and Andy. My name is Rowan and I live in Georgia. Though I grew up in St. Paul, Minnesota, and consider myself a distant cousin to Joe. I've been listening to y'all's show for over 2 glorious years now, and it's my favorite podcast of all time. I like to listen in bed early in the morning before I have to get up to go to work for the man. I'm 52 years old with 2 children, 2 dogs, 2 cats, and 0 husbands. I drive a 2013 Audi Q7 that I plan to drive into the ground. Then my dream is to buy a used Ford Lightning to go electric. My favorite beer is Negra Modelo, that's the dark one, but I've had to switch to Blue Moon Light to reverse an oncoming love handle situation. They've got a citrus wheat with a touch of orange that is delicious and refreshing. I tried switching to the Coors Latte on Joe's recommendation, but it just doesn't do it for me. I will never say no to a margarita on the rocks with tahini, and I keep meaning to order a Mai Tai in Al's honor. I am going to retire this summer after a 25-year career at the same company. I'm ready to downshift and de-stress from the corporate life, take some time off to smell the roses, and also to prepare for a second career as a part-time interpreter. So that I have a $56,000 annual cash flow cushion while I transition to my new career, I'm planning on rolling over $1 million of my tax-deferred $1.2 million 401k into a separate IRA from which I will start the 72T SEP withdrawals this year. I've used a handy 72T online calculator using the 5% fixed amortization uniform lifetime table to calculate this $56,000 annual withdrawal amount. So here's my really specific question for y'all to spitball. How should I allocate the $1 million IRA for the 72T to maximize growth over the 7 years I'm required to take the 72T? Also, how many years of the $56,000 annual withdrawals should I allocate to cash or bonds or CDs to hedge against sequence of return risk? Thank you so much for your hilarious and informative show. All 3 of you are making a difference in thousands of lives. And for that, you have our undying appreciation and gratitude. P.S. I'd like to retire in July and do the rollover shortly thereafter. So I'm leaving this voice recording to hopefully cut to the head of the spitball line. I'll be listening for you. Take care and bye.
All right.
That's a nice message.
Yeah.
I like that.
What interpreter?
Yeah.
I wonder what she's going to interpret.
Good question. I assume from one language to another, but
Interpretive dance, maybe?
I don't know.
that's what I think of.
25 years. She's 52. She's pretty young.
Very young.
I don't know if I like if I love the strategy.
Well, and we don't know enough about everything else to know, but yes, I mean, a 72T election, you don't do lightly, right? Particularly when you're retiring at 52 and you're taking $1 million of your 1.2. I hope you have a lot of other assets, Joe. This seems like a lot of money to be pulled out. And what if she, what if you find another career quickly, and then you still have to keep pulling this money out, right? And so I'd love to know how much money you have outside of retirement plans. Maybe you start with that before you go to a 52T, or maybe you do a smaller one, right? But I get,
Yeah, the 72T. So this is how it works. It's a separate equal periodic payment, SEPP. So basically, if you retire or she's separated from service at 52 years old, so you can't necessarily have access to an IRA until you're 59 and a half, you have access to the 401k at age 55. So if she wanted to just to pull it out just a couple more years and wait till age 55, then she wouldn't necessarily have to do the 72T tax election. But what it does is it allows individuals to avoid that 10% penalty. So she's going to retire at 52 in July and say, hey, I need access to this cash. I got $1.2 million in my 401k. I already recognize that I'm going to have a $56,000 shortfall. So I need to pull $56,000 from my retirement account, but I don't want to pay the additional 10% penalty. I know that I have to pay the tax on it. So as long as you take the separate equal periodic payment, so you have to take the same amount of money out of the account every single year for 5 years or till you turn 59 and a half. So in her situation, that's 7 years.
correct.
So $56,000 coming out over 7 years,
Yeah, it's about 400,000.
$400,000 plus tax.
Right.
You're looking at maybe half of the $1 million could be distributed out, assuming zero growth. So then the question is, all right, you're pulling 5.5% out of the account. How much money should be in cash to cushion against sequence of return risk? Because if the market tanks and we're in volatile markets, that $1 million goes to 800,000. She's still pulling out
Right.
$56,000 a year. So now that 5.5 or 5.6% distribution rate just went to 7%.
Yeah. Yeah. So to answer the question, so I'll put it this way. So assuming this is a good strategy, I would, which I'm not sure it is, but let's say it is. I'm going to answer your question. I personally would probably want to have 5 years at least of safe investments. That would be cash or bonds or things like that don't go down generally or don't go down much in a market decline. So that, to me, Joe, that would be 250 to maybe even all 400,000 of the money needed in safety, just to be safe. And like let's say it's 400,000,
Yeah.
and it's it's a total of 1.2 million. That's less than 40%.
Yeah, I mean, so the $1 million in the IRA would be a 60-40 split, 60% equities, 40% fixed income. In the fixed income, I would just go really short-term bonds, cash, CDs.
Yeah.
I wouldn't go long on your bonds. You probably will get a lot higher rate of return there, but you want to stay safe because bonds can fluctuate just as we saw the stocks can just a few years ago.
But yeah, me personally, I'd rather look at other alternatives. Maybe there's some other capital sources somehow. I know it sounds like you want to take a break, and more power to you. I think that's great, and you've got maybe some resources to be able to do that. Just be aware you kind of get yourself locked in, and it may not be a great strategy for 7 years. It may be a great strategy for 2 years, but you're locked in, and just think twice before you do this, I would say.
Well, she's done a great job of saving.
Yeah.
She's got a couple of kids.
Right.
$1.2 million in retirement accounts at 52.
It's amazing.
Right. So I think she can be diligent. She's if she has to reduce spending, she's got to save a little bit more. If she has to go back to work, I think she's the type of person that could probably do so, right?
Yeah, well, and that's a good point because
extremely successful individual here. 25 years at the same company too.
Yeah.
I mean, I would want to get the hell out.
we're almost approaching that
I
here.
know, I know.
That's
It's like, oh
that's
boy,
that's why you said that.
honey, I'm right with you. Let's get that.
Well,
Negro Modelo's on ice.
Yeah, the other point.
Celebrate with some margaritas on the side.
Speaking of a Negro Modelo, that was my dad's favorite beer when we went to Mexican restaurants. And so when I go to a Mexican restaurant, that's what I get in honor of him.
All right.
I'm a big fan of the Negro Modelo myself. I upgraded from Modelo Especial to the dark beer.
Yeah.
Yeah.
Got it. Yeah. Well, good luck. Thanks for listening. Love the voicemail. Good luck with your new career as I want to know what she's interpreting.
I bet she's working for the United Nations or something.
I mean,
maybe that'd be cool.
Like as soon as he said that, I thought about I just envisioned Rowan as like Nicole Kidman.
Really?
In the movie The Interpreter. I think
Okay.
with
Got
Sean
it.
Penn, I believe, was in it, or I forget what the hell the movie was called. Sean Penn and Nicole Kidman.
All right.
She was an interpreter for the UN.
Okay. Well,
Yeah.
that could be.
It's called The Interpreters from 2005. Yeah.
Yeah, she was
Right.
listening to, she heard something. She forgot her like violin in her little booth. So she goes back there and she hears something that she probably shouldn't have heard.
Got it.
And
Okay.
then it's off to the races.
All right.
So, yeah. Okay. Well, good luck. Let
Okay.
us know what that next career looks like.
Have you ever heard the term no regrets? It's a good way to live your life, but unfortunately, plenty of retirees have plenty of regrets. This week on a brand new episode of Your Money, Your Wealth TV, learn from their mistakes. Joe and Big Al show you how to avoid the 10 biggest retirement regrets and to set yourself up to retire happy and secure. They'll also share retirees' recollections on everything from lending money to boredom to give you the wisdom of the ages without having to learn it the hard way. Then calculate whether you're on track for retirement for free. Input your current cash flow, assets, and projected spending for retirement into our financial blueprint tool. It'll calculate a detailed report with 3 scenarios to help you determine your probability of retirement success with actionable steps you can take now to achieve your financial goals. Watch 10 big retirement regrets to avoid and calculate your free financial blueprint. You'll find the links to both in the episode description.
All right, we got Michael from Virginia. He writes in, he goes, I'm currently planning to invest $4,500 bi-weekly across VOO, QQQ, Google, Amazon, Microsoft, Meta, Berkshire, ASML.
I don't know that one. You got me.
I'm not interested in
It's a semiconductor company in San Diego.
Okay.
I'm not interested in international stocks or bonds. But this allocation makes sense for long-term growth given my goals? If not, what adjustments would you recommend? I would recommend that you invest in international stocks and bonds.
I agree with that. And you pick some really good companies, but all these companies have done great. And so maybe they'll keep going, right? But it's a little tricky when you're buying stuff that's gone up so far. You buy high and hope it goes higher. Sometimes that works. Sometimes you don't get as much growth as you think. So personally, I would rather have a more globally diversified portfolio, including foreign investments.
Why doesn't he like international stocks?
He's a pro-American.
A lot of good companies.
Yeah, there are. Yep.
No bonds? Doesn't like safety.
No.
Okay.
Yeah, and I would say we don't know how old he is, Joe, but I mean, the younger you are, the more aggressive you can be. So the more stocks you want to buy, whether it's in an ETF or index fund or mutual fund or individual securities, or there's nothing wrong with individual securities. It's just a little bit more work.
But there's been studies. If you look at, let's say, 100% stock portfolio in an 80-20 portfolio, the efficient frontier goes like that.
Yeah, the risk is
the level of risk that you're taking, you're not achieving any more reward for that amount of risk.
Yeah, and so the point of this then is when you look at risk versus return, the risk is higher for 100% stocks, but the rate of return is pretty similar, 80-20 versus 100%.
And you have to think about, all right, how do you manage the risk from a rebalance perspective? If I have a 100% stock portfolio and stocks get they crater.
Yeah.
You want to buy low. You want to buy more.
Yeah.
Usually, if you have a little bit of safety there, bonds, that could be a good cushion just to buy more stocks when markets go down, because usually bonds go up when stocks go down because there's a flight to safety, depending on what type of bonds, of course, that you own, and there's no guarantee of that. But if I have a little bit of cash or some safe investments, when stocks go down, I can buy more stocks with those. But if everything is in stocks,
I can't buy more stocks.
Yeah, I'm just waiting for it to recover or having the dividend reinvestment go back into the stock. So, but hey, I like the companies. Go for it.
Yep.
It's got some big hitters there, Big Al.
Big hitters is right.
What do we got up next here? Oh, we got Will the Gas Siphoner.
Oh boy.
Wow. It's been a minute since we've had Will on.
He wants to defend his honor here.
Okay.
Well, hello again, guys. Are we planning to try to defend my virtual
honor?
I know it's all fun about siphoning gas, but somewhere along the line, you may have dismissed my question as coming from somebody out there, so I submitted proofs to Andy.
He actually
Receipts
sent me
showing-
copies of his receipts that show that he saved $80 per gas fill up and a video showing the gas pump as he gets gas.
Okay.
This
Well.
guy's he's drinking too much gas.
So he is out there, is what you're saying.
So let's kind of tell the story here. So this
Yeah.
was years ago that he comes in. or
Right.
He
wrote it.
writes,
He wrote in.
He's got a question. And then he was like, yeah, and by the way, I get free gas. And we were like, well, what the hell is he
How do you
doing?
get
Is
free
he like
gas?
just siphoning gas?
And then he became
Pretty much one of the
Will
funniest
gas
segments
siphoner.
we ever had on the show. I'll link it in the episode description so that you can go back and listen and laugh.
But I recall a follow-up email from him where he really enjoyed the humor. So
Yeah, but it was like, I couldn't even read it.
He worked
There was
part-time,
no- there was no
full-time,
sen-
double
I mean,
time.
there was no beginning, middle, end to any of his sentences.
well, it's a lot
They
better
just
now.
kind of ran off and
There's periods and capital
Yeah.
letters at the start. So
Right.
you're good now.
Well, part of the charm of your podcast is about thinking of creative and legal ways to pay less taxes. Sometimes you urge us to think of ways to bridge the gap. Well, points, couponing, and cash backing nets us thousands each year to pay bills and expenses. Cash backing. What the hell's cash backing?
On your credit card, you get cash back.
Oh, cash back. Huh?
Yeah, yeah. You don't do that apparently.
I
No.
totally do that. And now they make it so that you can just spend the points right at the retailer themselves. It makes it so much easier than having to go
I
and
like
redeem
that.
them in your credit card. Yeah.
We just do the points for travel since we travel so much.
Do you have is there, well, we have a client that is like a
Yeah.
master at
Yeah,
this.
and has their own website on how to do all this. And she wouldn't tell us what it is, remember? We kept asking her, what? And she just said, that's,
No.
that's private.
That's private. That's my. But yeah, she was able to. I mean, they would go to Europe.
Yeah, 5-star hotels
Yeah.
and $30 a night.
See there, maybe Will's got a thing going here.
Couponing and cash backing. All right.
Yeah, I remember that particular client. Every month they were applying for a new credit card because they got so many more points.
Yep. Yeah. A
Yep.
dollar saved is worth more than a dollar earned. We save at least $3,000 a year, which
Right.
means pre-tax at 22% is about $3,800. $20 an hour salary means not working for 190 hours. That's a month. All right.
Well, that's worth it then.
Anyway, the math works to the question I had regarding backdooring all solo 401k net income to Roth IRA below the maximum $70,000 to start earning tax-free without having to save 3 to 6 months of living expenses. Okay, now he's getting a little off kilter here.
Yeah, I think
Did not understand.
I think what
he
he's
was doing.
asking is, can't I just have the money in a Roth and have that be the emergency fund? I think that's what he's trying to say.
Anyway, the math works to the question I had regarding backdooring. First of all, backdooring.
It's like cash backing. It's all a verb. These are all
he's
action items for
backbacking,
money.
He's spawning, he's backdooring.
Yeah,
Yeah, man.
that just means he's currently doing. He didn't backdoored. He's backdooring.
You know what? Well, my mind's going so.
You went somewhere else, didn't
All
you?
solo 401k net income to Roth IRA below the maximum $70,000 to start earning tax-free without having to save 3 to 6 months of living expenses. It doesn't have to buy anything yet, but it's already in a Roth account. How often does one need thousands in cash right away? My spouse part-time income would pay for immediate living expenses.
So that's the first question.
Okay, so what if your spouse gets
But-
loses their job and you need some money? Yeah, you can get your contributions from a Roth once you're over 59 and a half and you've had the account 5 years, you can get all monies out. But if you're not 59 and a half, it can be a little tricky.
And as
Okay,
for
you
how
understood
often
the
does
question.
one need thousands of cash right away? What happens if your roof falls in?
Yeah, I answered the question that I thought I heard,
Got it.
which was why not just have a Roth instead of a emergency fund?
Okay.
And if you have access to the funds through contributions or you're over 59 and a half, that can work fine.
Got it. Okay, cool.
Yeah.
I know you hate annuities, and I don't usually pay much attention because I don't think I had one.
You didn't think.
All right. Well, I do have Alec. Okay. The 5-year surrender term ended on 2014 and has been earning 3% since. I'm not sure whether it has life income part, but it looks like a CD. Is there supposed to be another lifetime payment? Since I'm under 59 and a half, I'm planning on doing a 1035 transfer to a deferred fixed annuity so there's no penalty or fee. 10 years fixed with 10-year surrender is about 5.5%, almost double what it is. What are your guys' thoughts? Or should I take it out, 85,000, pay the 10% fee, and put it into a brokerage account? Keep up the spitting of the wet balls.
Different way to say it.
Oh my God.
Spitting and backdooring.
All righty. Let's keep on spitting up those wet balls. Real examples.
Did your mind go somewhere else on that?
No, keeps it up. Well, regards, Will. Thanks, Will. It's always a pleasure to read your emails. Okay. So your email, annuity. So he's got a VALIC. The 5-year surrender term ended in 2014, and it's been earning 3%. So it's a fixed annuity earning 3%.
Yep.
I'm not sure if it has a lifetime income. No, it's just probably a straight fixed annuity at 3%. Is there supposed to be another lifetime payment? You could annuitize the contract at some point. I wouldn't do that. Since I'm under 59 and a half, I'm planning on doing 1035 transfer to another deferred annuity so there's no penalty or fee. So he wants to do a 1035 exchange.
Okay, and that's okay.
So if you're in annuity, you can't take the dollars out until you turn 59 and a half without a 10% penalty. It just works just like a similar to a retirement account.
And the 10% penalty is on the increase in value.
Correct. Because
not the whole thing.
Right. We're assuming that this is a non-qualified annuity.
Yeah.
So a non-qualified annuity is that, let's say Will here, it's worth $85,000. Maybe you put $50,000 in, and now it's at $85,000.
Right.
So there's $35,000 of gain or growth. That $35,000 would be subject to the 10% penalty and taxes if he took everything out.
Correct. That's
ordinary income tax.
That's right. Yep.
So he could do an exchange. So if you have an annuity that you don't necessarily care for or like, you could do a 1035 exchange. So what that does is put it into another annuity product. So there's no taxes due. There's no 10%. You're not taking it out of the annuity. You're just putting it into another annuity.
Right.
So that could be good or that could be bad. But it sounds like he's putting it into a fixed annuity at 5.5%, almost double, but it's a 10-year surrender. So you have to keep it in there for 10 years without a surrender charge.
Yeah.
And I'm guessing if it's a 10-year surrender charge, the commission on that is 10%.
I think I know if you want to go down that path about what's wrong with those.
I don't know. You could go into another annuity that doesn't necessarily have a long surrender period.
Yeah.
It's what are you trying to accomplish with the money that you have?
Well, this is probably a general rule. Those that have a long surrender period probably had a big commission, and probably there's reasons why you shouldn't necessarily do it. So just be aware of that. Not all of them, but just be careful there.
Yeah.
There are annuities, Joe, that have no costs, no fees, no surrender at all. So why not look at one of those? That's what I was saying.
Sure. I mean, like a fixed annuity works similar to a CD. So they're going to give him 5.5%.
Right.
Guaranteed.
Right.
That's a pretty big guarantee.
It is.
And so for 10 years.
Right.
And so they're going to take that money and they're going to try to earn more than 5.5%. So that's why you got to keep it in the product for 10 years.
Right.
Because over a 10-year time period, they're thinking, hey, we're going to make more than 5.5%, and that spread is how they're going to make their money. If you take the money out prior to that 10-year, there's going to be a pretty big surrender charge because they had to pay the insurance agent to sell you the annuity. They had to pay you the 5% interest rate on the money.
Mm-hmm.
And so,
yeah.
But yeah, I like 5.5%. If it's real, it's guaranteed.
Sometimes it's factors and it's not
Yeah,
really
who
real.
knows what it is? I mean,
Right.
they could be saying, all right, well, it's a fixed index annuity and it's average 5.5%.
But that's not really your money. That's what your earnings are based. Yeah, it can be tricky. It
So
really can.
yeah, I would want to understand the annuity that you want to get into a little bit more. But if it's a straight fixed 5.5% guaranteed every single year for 10 years, then I don't know. That sounds okay.
Yeah, if that's what it is, that's great.
All right, Will the Thrill, tucking on gas.
Pure Financial Advisors now has 12 nationwide locations. We're in Mercer Island and Redmond in the Seattle area, Northbrook and Wheaton in the Chicago area, Greenwood Village in the Denver area, Prescott, Arizona, Lehigh near Salt Lake City, Utah, and in 5 California locations: Davis, Brea, Woodland Hills, Irvine, and our original San Diego headquarters. Pure is still growing, which means more experienced professionals on Joe and Big Al's team, able to provide you with more one-on-one conflict-free financial guidance from more locations without selling you any investment products. But here's the thing. You can schedule a financial assessment with Pure no matter where you are. That's literally what Zoom is for. So even if you're right next door to one of our offices, but you'd rather get a professional, free, in-depth review of your finances while you're at home, in your jammies, on your couch, you totally can. Just click or tap the free financial assessment link in the episode description to book yours. Or if you'd rather do it the old-fashioned way, just call us at 888-994-6257 and schedule your assessment now. And if you're still not sure, check out yourmoneyyourwealth.com to learn more about us, then hit the green Get an Assessment button at the top of the page.
Let's go to, hi, I love your show. Informative and funny. I have an ESOP and NUA question. We are Tess and Finn, 45 and 48. We have 3 teenage kids and 1 dog, and we live in Texas. We had a lot of Texans here today.
We do.
Love the great state of Texas. We enjoy a little Tito with cranberry or soda. Finn works for a private company and has a substantial amount in this retirement ESOP plan. After 25 years and hopefully 12 more to go, and all the company match plus strong appreciation, we are concerned about RMDs since this is all pre-tax dollars. On a previous episode, you briefly explained how upon retirement, the ESOP can be rolled into a NUA. Please correct my understanding. The amount Finn in the company contribute is taxed as ordinary income, and the appreciation is taxed at long-term capital gain. From what I read, I think I understood that the contributions will be taxed in the year of the retirement rollover, but the NUA, the appreciation portion, won't be taxed until it's sold. Since the company is private, can a brokerage account hold a publicly traded stock?
Non-publicly.
Let me go. Since the company is private, can a brokerage account hold not a publicly traded stock? I don't think Finn's company allows him to get the company stock after retirement. It seems that we would have to sell the shares of the stock when we do the rollover to the brokerage account. And does that mean everything I get taxed in that year? When I first heard about the NUA, it sounded too good to be true. But if we have to pay all the taxes in 1 year, that's a scary thought. And I'm aware of the rule of 55, but I think the NUA, you have to wait until 59 and a half to use. Is that correct? General question. Why don't more companies use ESOPs? Okay, so there's 2 different kind of things here.
Yeah.
There's an employee stock ownership plan that companies do to kind of share the ownership with their individual employees to get them equity within the overall firm. Most private companies have ESOPs. They're not publicly traded. So if you're thinking about, hey, can I do a net unrealized appreciation on a non-publicly traded company stock? That is pretty challenging and difficult
It's challenging.
to do.
You can. It's allowed, but the employer typically doesn't allow you to keep the stock once you retire, right? So you would have to sell it. So your understanding is right. And you could do a NUA, which basically means you take the stock and generally you put it in your brokerage account if it were a publicly traded company.
So let's use an example of a publicly traded company.
All right.
So I work at Sherwin-Williams.
Okay.
Good company.
Yeah.
Very strong stock.
You like paint?
I do love paint. I like it a lot better than Bear. So I work at Sherwin-Williams, and I got $500,000 in company stock inside my 401k plan.
Got it.
And I have a cost basis of $100,000.
So you invested $100,000 into this stock, and now it's worth $500,000.
Correct.
Okay.
And so what an NUA or net unrealized appreciation is, because it's publicly traded, I can say, all right, well, here, I want to take my Sherwin-Williams stock out of my 401k plan.
Right.
So you pay ordinary income tax on the basis.
So $100,000 the year you do it.
Throw it in the brokerage account. $100,000 is added as ordinary income on my tax return. Now I have Sherman-Williams stock sitting in my brokerage account.
Right.
So if I want to keep Sherman-Williams stock, I can keep Sherman-Williams stock. If I want to sell it, now I'm subject to capital gains tax on the appreciation.
But you sell it when you want to.
Yes.
Yeah, so you don't pay the tax. That's how you sell.
Yeah, I can
You can sell a little bit this year, a little bit next year,
Oh,
a little
good.
bit in 20 years, whatever.
Privately held companies, CEO of that company, the owner of the company is like, hey, you can't just carry my stock.
Yeah, that's the whole point. The reason why there is stock ownership in a company is a privately held company is the company, the management of the company, the investors of the company want employees to have stock ownership, so they'll act more like owners. They'll do a better job, right? But once they retire, it's like, okay, you've done your thing, and now we want to cash out your stock for what it's worth at that point. So even though it's technically possible to take an ESOP, stock shares and go ahead and do the NUA, in almost all cases, the company would not allow you to keep the stock, which basically negates the whole thing, Joe, because you'd pay the ordinary income tax on your example of $100,000, and you'd pay capital gains tax on $400,000, all in the same year.
Yeah.
I wouldn't want to do that.
You just roll the ESOP into an IRA.
Yeah, exactly.
Just cash it out within the ESOP, get cash in the ESOP, you roll it into an IRA, no taxes due. Then you just pay ordinary income tax on the distributions.
Yeah, by the way, if you have publicly traded stock, and generally this is more common in a 401k than an ESOP, but so I'll give you three things have to happen. First of all, you have to be either 59 and a half, or there needs to be a triggering event like you retire. So that allows you to do it. Secondly, it's all or nothing. You have to do a lump sum on the entire thing, so you're not in the plan anymore, right? And the third thing is the stock shares have to be transferred out. You can't cash it out. You have to actually have the shares, which is why a non-publicly traded company is very difficult.
Yep. All right. You had a tough week, huh?
I did have a little bit of a tough week, and my mom passed away last week, and so she was 91 and a half, which was great. She lived a long, fruitful life. She was very kind person, very caring person, kind of a service-oriented person, wanted to help people always. And all of her kids were there when she passed, which was great. And 7 of her 9 grandchildren saw her that same day. And that was probably the main thing she told me over the last couple of months or few months is like, when I do pass away, I want you kids to be holding my hands. So,
oh, wow.
So that's what we did. Yeah. So I had a friend, Joe, that said, I think you hit the mom lottery with the mom that you got, which I tend to agree. So that was amazing. I'm going to miss you, Mom, but thank you.
Oh, making me cry, Big Al. Well, yes.
Al, what's your mom's first name?
Betsey Clopine. Yeah.
All right. Well,
amazing lady.
Perfect.
Yeah.
All right. Well, that's it for us today. Thanks for listening. God bless, Big Al.
Thank you.
All right. We'll see you next time.
Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.